All right, stock started off September with a little bit of a decline. A little, so far, kind of what we expected based on what we discussed in Friday's video. So now, how much more of a decline? Did we fill in enough of the gap? Is there more to come? How much more of the August move do we have left to touch? We're going to talk about all that and some signs that from other markets that might give us some indication of what to expect here in September for the S&P 500. And we'll talk about too some sectors that are correlations that are kind of giving us a signal too in terms of how risky or what our risk appetite should be. A few safe haven sectors in particular doing pretty well, and other sectors not. And we'll look at our trade idea in one of those sectors that's been kind of flying under the radar a little bit in terms of its underperformance, and we'll take a look at it for a trade idea for today. So let's go ahead and get started. Today is Tuesday, September the 3rd, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we pulled down. In fact, we closed below yesterday's low point, Friday's low point. We talked about this being a bearish pattern on Friday, closing at the moving average like that, coming off these lows, hitting a downward, a descending moving average with light green shading. Usually you get a yellow line there. We can really, just marginally missed literally by about 0.15 of a point, missed having a yellow line on the moving average. That combination of a yellow line and light green shading, after you've been strongly bearish for a while, can be a bearish selling pattern. Again, I've shown patterns, other examples of this in the past. Over here on the right, and the same thing in the opposite direction to the bullish side. So it was a bearish pattern setting up on Friday, and we've pulled back. The near-term lines pulled back down. Again, now the question is, where is the next near-term low point going to be? Because this was a bullish. That was kind of our first we've had bullish highs, we've had bearish lows, but this is the first bullish low. We haven't had a bearish high, but that's our first bullish low. So now the question is, are we going to get another bullish low where we bottom out below 50 and above this high point on the S&P itself? So the expectation is probably not. We'll probably come down and retest this 62% Fibonacci retracement. I would even venture to guess by the end of September, we'll probably at some point this month test this level, the 78% Fibonacci retracement level, according to how things have traded, how markets have traded in the past when we've had such a negative month with a long lower shadow in August, as I mentioned again in Friday's market outlook video. Of course, the posture is still weakly bullish, so you still have light green shading, but you still have the red line. So, again, that's tends to be a bearish combination. Usually, that leads to dark pink shading, which means the intermediate line turns back down and heads back towards the moving average here. So the momentum line is down technically by definition as a bullish intermediate confirmation signal. That's a very, very weak bullish intermediate confirmation signal because your intermediate line is not even above 50, and usually you kind of want it above 80, and you don't have your near-term line below 50 yet, which also strengthens that signal. And again, that is a bullish near-term high point, but keep in mind that we've only been above 50 now for, let's see here, it'd be 1, 2, 3, 4 days, and the typical time frame is 5 to 7. So you can see we're not getting a good extended run on the near-term line above 50, and that's one of the reasons why these weak bullish intermediate rallies haven't been able to get it across 50, get across midfield, so to speak. It's like every time the Bulls get close, they have to punt, and the Bears get the ball, and they usually get the ball back in good field position if you continue that football analogy. So, I expect, according to the pattern, that we'll continue to push, most likely to the downside. I saw a tweet that said today that the markets got crushed, and it's like, we're in a sideways range. We went down today, but we're still in a range, so you can't really get crushed or, take off unless you really break out of the range one way or the other. Here's the light green shading with the yellow line on the Dow Jones Industrial Average. because we did close above on Friday. Again, bearish pattern there. You can look at the NASDAQ composite. Did not get the yellow line like the S&P, and you can see it rolling over as well. Again, these closes below Friday's low point, close below the low of the high day, so to speak, are not necessarily the best sign. Of course, the Russell's was the worst today, down 1.5%. Its near-term line did drop below, and its intermediate posture remained strongly bullish. It never did get the green shading because we never got the intermediate line above 20. So we have a strong oversold intermediate posture here. That continues to be the case going forward. A little bit of an evening star candlestick pattern. So bearish patterns all around, and according to the dark pink shading, red lines that you see here, that you expect to see here, we expect that will be bearish for a little bit longer. Now, will this bring the market sentiment line down below 50? Probably not. You can see we had we actually had a deeper drop here from on an absolute basis, and that didn't lead. That didn't lead to market sentiment pulling back, and I don't think we'll get that here. But I do think that we'll probably get closer. Similar to how we, maybe even a little bit closer than the market sentiment line got back in June, and based on that pullback. But I don't think we are in this type of rally or drop where we had such a big drop that brought the market sentiment line as low as it did. We're not in this mode, but I think we're more in this mode, which means, especially considering that we've been so sideways here for a while, whereas this move was down, pretty quickly here, that because we've been so sideways, it allows us to have more downside momentum without really throwing things off kilter, so to speak, and really falling off a cliff. So I do expect more bearishness. I expect that we'll probably, like I said, by the end of this month, get down and touch this dotted line, the bottom of this bigger Fibonacci retracement zone that we had of the prior intermediate rally, before we find a new intermediate low point and then rally back up again. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. If you're watching us on the YouTube page, there's a subscribe button down below the video as well. There's also a bell. Click that bell, and that will notify you when these videos are posted. You can hit that thumbs up icon down below the video too. That tells me two things. Number one, you got something out of the video today. You liked it. Number two, that you want us to do it again tomorrow. So, if that's the case, let us know. It's the only way we can see what you think about our videos. You can do that right now, actually, while you're watching. And remember, also comment down below on anything that stands out to you from our video today. Join our daily market outlook email list. There's a link popping out on the top right corner of your screen there. Click on that link to subscribe to our list. Follow me on Twitter for more content in between the videos, and join our Market Outlook community on Facebook. If you're watching our Market Outlook video here on our blog at marketscholars.com, which you can see up here and you can get to, I wanted to point out a few things. First, there's our link to our Market Outlook Live. There's a lot of people asking me about tracking these trades, following up on them, managing to their close, that we talk about in these trade ideas day in and day out on the Market Outlook video. That's the link that will take you to every day's, and there's also an archive of previous days where we manage the trades that we've made in these videos, and then we actually place today's trade before the market closes, so you can be able to catch it there before the market opens tomorrow morning. A few other things too, you can see other posts, but we also invite you to engage with us on social media. That way Twitter, Facebook puts our content at the top of your timelines. As I said before, Twitter doesn't show my content to everybody who follows me, or same thing with Facebook. A lot of times simply because you just don't happen to be looking at the same time the content gets posted. But they will still post, they will show you content that you engage with the most. So we try to make it really easy for you to engage with us. Just hit this little heart that will like the Market Outlook tweet for tonight. Click that like button. Click on this image. It takes you to your Facebook page. You can like us there. Again, the more you engage, comment on the tweets and reply and retweet and like them, the more you can make sure that they continue to put our stuff at the top of your timelines. I also quickly wanted to mention too that our plus and both our plus and our premium subscribers get access to our Market Outlook Live. We have details on all the levels, all of our subscription levels here on our pricing page at the top left. But you can get a free trial to our plus subscription over here. There's a link right above the video. Gives you a 30-day free trial, so you can, part of that trial not only are these 2 classes that you can attend every week, but also access to these videos when I put these out on a day-to-day basis. All right, back to the charts. Let's take a look at the long-term chart here, and you can see, again, last week we got that transition candle week there. This week, even more so of a candle, and you see how, of course, today's range was very, very minimal compared to 87-point range, which has been gradually getting smaller as we kind of sit in between the 50 and the 200-day moving average, getting back down. If you look at the regular candles, getting back down below the 50-day moving average here. So relatively bearish. You can see the momentum is still positive, so it's not like we're looking for bear markets here, but it is declining. So that's another sign of weakness. I mentioned the weekly chart last week on the Russell 2000 for the market forecast chart here, if I pull up the Russell, and that it had its own dark pink shading and red line. Not a good sign on a weekly basis here. If we take a look at the S&P 500 and say, okay, well, how close are we to that pattern? Not quite there, right? We're getting the light pink shading and the yellow line, which is a relatively bullish sign. So the question now is, are we going to get back above these highs and break out, or are we going to pull back down and join the Russell in that pattern? It won't be this week or next week when it does turn pink, dark pink with the red line. But the fact that the Russell is showing it, is a relatively bearish sign, so to speak. If you look at the 3 green arrow charts for the S&P, again, we're getting, let's look at it this way. On the 2-line versions of the 3 green arrow chart, you can see the MACD is right up against 0, not crossing up above. In fact, after getting above the 17-day late last week again, we're right back down to the point where we might get back down below the 8-day. In fact, we were down below the 8-day moving average there for a time today. So it kind of shows just how things can turn around pretty quickly after finishing the week relatively strong last week. All right, when you look at the S&P on an intraday basis, you can see, just like we talked about again on Friday, that there was a good chance that we'd fill in this gap this week, and we just like that's what ended up happening. Now keep in mind too that now we had a morning gap here that we haven't filled in yet. So we at some point in time we expect, while we filled in most of this gap, we expect that gap to be filled in at some point too. So we're not going to fall off a cliff anytime soon. There is opportunity to move to the downside, but not before we potentially even retest this 292 level again within the next day or two and fill in that gap. There was a little bit of a bump in volume here, not a dramatic bump. It didn't even get to the average. The average is declining. So it wasn't a huge bump, which means more likely than not that this is, a common gap as well, which we would expect to get filled in sooner rather than later before things, but again, very strong resistance building up in this area and the opportunity to move. The gap between is only 13 points. You consider that a 5% drop is the 13-point gap here between the 294 and 281. That's less than 5%. That's a pretty small range. It's what that means is more than likely it's going to limit the upside moves. And still, it doesn't mean that we can't move to the upside, but we've already kind of stretched out here considering we're off of the lows. But if we break, there's opportunity for that, 5% range to expand and get stretched out a little bit. And, where is it more likely to expand? Well, we'd expect it would expand more to the downside. But even then, you can see there's still a lot of room here for us to not only refill that range, but test down into this area, down to 284, and still not be significantly bearish. If you look at today's volume again, look at the range along with that volume. You can see we had 69 million shares trading hands in the range today at 2.31, but keep in mind the gap. We closed at 292.45, the high at 291.58, so about another point added on there. So you're still not even up to average, and you were actually a little bit below the average too on the volume. So again, it's a bullish sign to have these lines coming down, not a bearish sign for the market. So if we test 280, especially if we can test 280 without a big jump in volatility, then there's a good chance. But there's also the possibility that we don't ever test 280, that this is the extent of the pullback now that the market has got the tariff the tariffs from the US and China over the weekend. There's a good chance that we might just start to bounce back up, and now that we're priced in the worst case scenario, and the worst case scenario coming to play, we might break through. And again, more than likely we're going to have to gap through this 294 area with a good bump in volume for us to get a really good hold, and not just like this where we kind of move up a little bit with a gap with not very much volume, and then that gap gets filled in really, really quickly. You can see that scenario generally leads to more selling, like we got the rest of Friday and into today. All right, before we look at some other charts here, just to kind of summarize our technical outlook based on these charts, we're in a range. We hit the top end of the range on Friday. It resulted in a relatively bearish kind of near-term intermediate pattern, which started to play itself out today, and I expect will continue to play itself out going forward. But we're not seeing any surges in volatility that would suggest, that we should really prepare for the worst here. It's more likely that we're kind of stuck in a range and waiting to break out, waiting for the right catalyst to break out and start a new intermediate run, whatever that catalyst may be. You look at multiple factors we'll look at here in a minute that's still kind of providing plenty of risk aversion, excuses for risk aversion. But the reality is, especially considering how low, like yields have gone, we're not in a total risk off, and also especially compared to our international counterparts. We're just kind of, just nice and steady in range trading, and we're in the midst of moving towards the lower end of that range. And we might pop out a little bit here or there to the top side or the downside, but until we do it with, a good bump in volume and a decent, gap, or decent move intraday that's also accompanied with all that volume, then we just kind of have to, to pick our spots both to the upside with bullish trades and to the downside with bearish trades, to make sure that we're balanced, so that we can be, we're not caught on too much on one side of the market if it were to break out of the other. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out top right corner of your screen up there. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, scroll to the bottom and let me know what you're seeing. That would suggest either that you're a lot more bullish or a lot more bearish than what we came up with here. All right, now let's get into what's driving this action. You can see over here on the left, I mean, it was a risk-off day, and you had the VIX up at the top with gold and real estate and the dollar, and then on the other end of the spectrum, you had crude oil and small caps, and all U.S. stocks for the most part. You can see emerging markets down a little bit, developed markets holding up really well, relatively speaking. If you take a look at the asset class comparison and just look at today and how they perform. Oops, we'd be in September now, aren't we? And just look at today here. You can see that gold started out the day strong and stayed up strong. Long-term bonds started off strong, pulled back to a loss by the end of the day, whereas the dollar held up and continued. Remember, the dollar has had a little bit of a breakout last Friday, and it's continuing with that move. A little bit of a shooting star pattern that can be bearish in the intermediate term. You got the bullish combination of dark green shading, green line, rising market sentiment above 50, that's a very, very positive technical pattern. Of course, nothing's 100%, but also considering that how far away we are from the moving average in the past, that has been that's been a bearish sign. In fact, if you were to look at the 3 green arrows here chart and pull up the dollar, and then let's just pull up on that MACD the current price relative to the 30-day simple moving average here. And we'll hit OK and hit OK on that. You can see we did get higher over here, and we're not as high as we've been there's been a few other times we've been higher, but you can also see we're kind of getting to the level where we've peaked in the past, right, on all these dollar moves up to the upside. So we'll see if that ends up being the case again. If you take a look at the long-term chart for the dollar, and you can see the breakout pattern, the high on its Hakinyashi this week, really looking positive, going into being above a rising 50-day moving average, and that 50-day moving average rising above its 200 with plenty of room to move to the upside if that were to be the case. Of course, the 10-year note, it continues to drop and fell down. Well, it was only down to 1.46, but had fallen a lot more than that. In fact, I tweeted this out here, that the 10-year note has fallen 50% in 6 months. That's a pretty steep rate of change that we saw during the credit downgrade. We also saw it at the end of 2008, and that's it over this 20-year period. And if you look at the PPO, which is the MACD, but the MACD relative to, in this case, the 40-week moving average, we've got stronger momentum now than we did in both of these periods. So this is a significant decline for the 10-year note, and a decline that we don't generally see when there are yield curve inversions. Usually the yield curve inversion is in the midst of a rally in yields, not a decline, especially one to this degree. So this is one of those instances where we haven't ever seen this scenario in bonds play out again when the yield curve inverts at the time of the at the time of the inversion. So, and in fact, the 10-year note being down this much this fast, which means that bonds are up this much this fast, usually doesn't precede recessions. Usually it kind of coincides with the end of recessions. So another interesting tidbit for those that are expecting recessions. This is kind of a pattern that, as much as people say the yield curves are such a good predictor of recessions going forward, the yield itself, in this case, would be pretty much the exact opposite, where it hardly ever has done this before a recession. Usually it's in or towards the end of one. The other chart I wanted to look at here was crude oil. If you take a look at the futures contract, and actually let's go to the market forecast chart and look at it. You can see how we are close to getting the bearish pattern again. We've had it where you had a dark pink shading in the red line. The red line is back, and the intermediate line is close to getting the dark pink shading again. If you look at the weekly chart, we do have that combination. We do have the dark pink shading in the red line, and you can see the red line is up a little bit this week. So we'll see if we end up finishing with a red line. If we finish down at the lows of this week, I would expect that value right now, which is up 0.04 of a point versus last week's value, to come down. So it's not like we're significantly higher, and we're poised to be more bearish. And in the past, that's a bearish combination, especially with market sentiment line dropping below 50. And crude oil has been a kind of a reflection of risk appetite in general. Yes, we're not, here we peaked. Remember, we peaked in the stock market in January 2018. We went up slightly higher And then we went up much higher here again in July of 2019 before pulling back where we are right now. Of course, the big drop here in December. We'll compare those peaks to crude oil, and you can see in crude oil we peaked here. We did a peak again in July. We actually peaked a little bit higher, but just barely in October before falling. And then here we actually peaked up. Here let me show you on the left scale the S&P 500, so you can see a comparison. There we go. Pull up the S&P 500. So again, very similar patterns here. Higher highs. But this was a higher high in the S&P, and it wasn't on crude oil. This was a much higher high in the S&P, and higher than this one, and it wasn't on crude oil. And so you can see how we're, the comparison between the two, and they've been pretty, moving up in lockstep since early 2016. They both rallied pretty sharply here to January of 18. Before, with previously the crude oil dropping so much, really keeping the S&P in a tight range and a multi-year range here starting in late 14, going all the way through 15 into early 16. Well, that's quite the divergence and discrepancy. And if crude oil continues to be bearish, there's a lot of ground to be made up in terms of equities being a lot more bullish than what the relationship with crude would suggest. Let's take a look at how the sectors are performing here today. And not surprising to see utilities and real estate. And if you saw my post here, the post is the current the correlations that we posted on our blog. Again, you have to be a subscriber to get to our market commentary post on our blog, and it's free subscribers, all it takes. And you'll be, if you click on that link, you can subscribe for free on that page. But you'll see that the correlations had quite the change. Big time drop in correlations this week, and utilities and real estate were the biggest culprits, and they continue to kind of do their own thing, as we saw on that chart. Those are pretty big gains to the upside, whereas industrials and technology and financials are your biggest losers. Your kind of cyclical sectors are your biggest losers to the downside. If you take a look at the sector, the 12 grid here, and look at utilities and real estate and how much, that's almost like blow off top type rallies, especially when you see, everything. We're above, strong bullish postures above rising moving averages. Staples as well to a degree. Everything else is below falling moving averages. Just technology and discretionary just kind of flirting with it, and industrials has moved back down, and you can see these, energy really struggling. Everything is below falling moving averages, even with slightly rising intermediate lines. Discretionary, the only one above 50 on that, so that one's got dark green shading, doesn't have the green line yet, of course. And then technology would be the only other one that's closest to crossing above 50 besides these top three. So doing their own thing. And again, when correlations, when we are close to a low point in the markets where we're about to turn around and start heading higher, usually correlations are pretty high. All these sectors kind of look the same as the broad market as a whole. It's whenever we kind of still have more risk off moves or a better way of saying that, because the risk off trade is actually pretty overbought as it is, but the risk on trade is not oversold. It's really, it's bearish, as you can see. A lot of these cyclical sectors, especially energy, moving to the downside, but it's hardly oversold at all. In fact, over this 6-month period, the S&P is up 6%, and is actually one of the better performers compared to other markets. Again, as I've shown you before, when you compare the S&P compared to other markets, and this is over a 3-month chart. This is go to a 6-month chart. Only Russia's got a stronger gain against the S&P. Everything else, in China down 11%, and UK, Germany all 5 to 7% declines. Despite the S&P being up 3%. So the S&P itself is, this risk on trade is only oversold and when it's not a U.S. asset class. U.S. assets priced in dollars have been really, really bullish here, when you include, of course, bonds and gold and things like that. All right, so the trade idea that we put on today during our Market Outlook live session, again, those occur at 3:30 Eastern time, a half hour before the market closes. It was on BSX. It's got the this kind of developing bearish pattern. The moving average has gone down slightly. The intermediate line is rolling over as well. It's got this kind of line of successive bearish high or bearish peaks here. The near-term line has been unable to get into a reversal zone in the last two peaks. It really hasn't dropped in yet. That's why it hasn't broken out of this range. It hasn't dropped yet into the lower reversal zone either. If you take a look at this high point that we have up above us, though, all these moves up to the upside has created this really strong resistance up here. Again, it's going to be difficult for without an earnings or without a market breaking out. It's going to be difficult for a stock like this to break out to the upside, especially when there's a void of volume down below. I mean, there's all these touches in this area, but with very little volume, that there's been, this void, basically a gap in volume to fill until we get down to about $40, which is $1.67 away from us. So the path of least resistance, if you're looking for the next $1.50 move, is to the downside more so than it is to the upside, with a significant resistance up above where we're at right now. If you look at its DMI chart here, you can see unlike these other drops that we've had, this one did get the orange line up above 25. Now it's not significant. We're not starting this bearish move yet. That's why we're not looking at directional trade on this. But it does suggest that there's enough bearishness here to give that resistance a higher probability of holding, higher than it already has anyway. And the blue line is not below 20. Keep that in mind. That that's why another reason why again we're not looking at a directional trade on this. It's more of a higher probability outlook. You take a look at its 1040 cross, and you can see that. We've had some bullish momentum. It's been progressively getting weaker. Again, another sign that when these divergent highs are formed, it's another sign that there's a good chance that high will hold here for a while. The other thing too that stood out is the 3 green arrow chart on BSX. The other bullish attempts brought the 17-day, the red line, above the 30. This one didn't quite, but it did brought the 30s well above the 17. Well, in this go around, the 8 got above the 17, but the 17-day never got above the 30. And now the MACD is dropping back down below its moving average. Stochastics looks like the intermediate line peaking at a lower highs. And so there's opportunities here for a bearish standpoint. Again, not to be too directionally bearish, but especially lacking a catalyst, barring any news announcement here. To break through a significant resistance means that we can sell options, at that resistance level. We can sell the, $43 strike price, which is right where that point of control or that volume node is, by the 45 in case of a breakout, and you get enough credit to make this trade worth the risk. And then again, if this were to break on through to the upside, then we try to keep our losses to the same 53 cents. It makes it easier to offset that loss versus, say, taking a full $147 loss, which you could see would take about 3 of these trades to just break even. And you'd have to be right 3 times in a row, which, if you got 75%, let's just say you're being really conservative and you say you have a 75% chance of success on each one, to get 3 in a row would be a 42% probability. So it's a pretty low probability just to get back to break even. So we like to avoid taking the full losses as much as we can. Keep the losses smaller. A lot easier. It does increase the lower the probability of success, but it makes it easier to be able to offset those losses, especially again when you consider that here, edit this trade and let's put this on. And let's just get rid of the position for now and just look at the simulated trade. When you consider that $50 loss level, is right there about 44. So if we were to break through 43, we'll probably end up taking that. But it's not going to be easy to get above it, and that's the whole point of doing, a vertical spread here is, we're not necessarily bearish enough to say let's buy a put or do a long put vertical spread because this thing's got some downside potential. But there is enough downside pressure and a significant enough of a resistance level above us that there's a good chance that resistance will hold, and we can be able to sell the call options at that level and be able to profit from that. So all right, so that wraps us up for today. You've heard from me now. I want to hear from you. There's a link popping out up there in the top right corner of your screen. Use that link to go to our Market Outlook forums on marketscholars.com. You have to subscribe to our site for free to be able to participate. You have to have an account on our site to participate in our forums, but you can get one of those for free. And then ask any questions or comments you have on today's video. Open up any new threads and reply to anybody else's thread with what they're talking about. And let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow us on Twitter for more content in between the videos, and join our Market Outlook community on marketscholars.com. As well as the community that we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.